Yeah. Urian, one of the reasons I love this chart so much is I think it visually represents something that market participants sense and are maybe a little bit worried about, right? Which is if you kind of look back at these periods of time that you've labeled as restrictive here, which is when interest rates essentially go above that natural rate of interest, the R starred. That typically precedes some sort of large, recession or market crash, right? So that was kind of right before 2001, right when we had the dot-com bubble burst. There was right before 2008, when obviously we had the great financial crisis. And interestingly enough, right? I mean, people actually talked about this. The yield curve actually inverted right before COVID as well, which did. And Harley Bassman asked, did he predict COVID? I don't know. But basically, there's this pretty well-worn pattern historically of when the Fed does tighten, eventually they do it to the point where they break something and then they ease. The other pattern that you can see going back in time here is that the Fed typically had much more latitude to get tighter, right? They could go way above that R-starred line before something broke. And now, I think the worry and maybe why there's a lot of kind of doom and gloom out there is you can see over a period of time where that blue surface area above the R star where the Fed can be more restrictive and kind of curb excess in the market is getting less and less and less with time. So I think the worry here, and maybe if I could ask you your opinion, I don't think it's overly bearish to say we're going into a bear market. The worry would be that we're looking at down the barrel of a pretty nasty macro setup here, just between the debt, between kind of this double barrel recession, right, where you've got the earnings and the PE falling at the same time. And, we've got inflation and, historically low interest rates. So I think folks have already kind of made peace with the fact that the market is going lower. The question is going to be how far, how fast? And is this going to be something that feels very, very long, like a long sustained kind of bear market? Or do you see some sort of recovery? Because it's just hard to see where the Fed can step in having so little wiggle room, if that makes sense.
Yes. And also the Fed doesn't have the room for that kind of to execute on that Fed put, right? So one thing you just point out to correctly is that the economy is more levered to low rates than it has been in the past. And that's why those highs, that chart shows lower highs and lower lows. And it would argue that maybe neutral is the new tight, right? So maybe we don't get to the 200 to 300 basis points above because the economy can't handle it, right? I mean, it's a highly financialized, levered economy. The households are not so much levered. That was the financial crisis where that happened, where people had equitized their home equity or monetized their home equity, I should say. But certainly it's the government this time. And of course, the government has an infinite ability to fund itself. But corporate leverage is pretty high. So there is a limit to how high rates can go before it starts to really impact the economy. But on the other side, the Fed put is kind of out of the money at this point, right? So in the past cycle, like in 2018, when market went down 20%, even during COVID, even in previous cycles, when the market started to unravel because the Fed was tightening, the Fed could easily pivot because inflation was just not a threat, right? I mean, after over a decade of failing to meet its inflation target to the upside, right? Like it would be below the 2% target. The Fed kind of felt, or the market felt that the Fed had the luxury of just kind of pivoting towards keeping the markets afloat because there was no price to pay for that. At least that was the perception. I think we can all maybe think differently on that. But that put has now been taken away because inflation's at 8.6%. And, the TIPS break-evens are much, much lower than that, but they are, fairly sticky, but much lower, around 3.5 on the 5-year, closer to 3 on the 10-year. The 5-year forward is still only around 2.5. But this notion that if the market goes down 20%, the Fed will just reverse course is not going to happen this time around. So it really just depends on how quickly those rising rates will impact the economy. Like I think on the housing front, we're going to see that pretty quick, right? I mean, if you think about home prices are already up 20, 30+% over the last couple of years. On top of that, mortgage rates went from a 3 handle to a 5 handle. I saw one estimate somewhere, not my number, but I read it, that the cost of buying a home is up like 60% in the last year through a combination of rising prices and rising mortgage rates. That's gonna fix, I think, that inflation problem perhaps fairly soon. And that's happening as new supply is probably going to hit the market in terms of houses in different parts of the country where real estate development, is where there's room for that. So maybe the housing side will crack first, and maybe that will take some needed steam off the inflation. Then you still have the energy side, of course, oil and gas, and there doesn't seem to be any relief in sight on that matter. But as the old saying goes, nothing cures high prices better than high prices. So maybe we're at that point, or not at that point, but maybe we'll get to that point as well. And so I think if at some point that inflation fever breaks, and it breaks because the economy breaks, at that point, the Fed could pivot fairly quickly back to an easing scenario, unless we get into some sort of prolonged stagflationary regime. And then I think the Fed would have a very difficult decision to make, because let's say the payroll numbers start becoming negative. Like right now, the payroll numbers are strong, unemployment rate's at 3.5%. Pretty easy for the Fed to say, we got a dual mandate. We're going to favor the inflation mandate this time around because we're so far from a recession in terms of the employment picture. At least that, I'm guessing that's might be what they're saying. But if the employment picture starts to crack and inflation is still a major problem, Fed's going to have to choose, right? It's going to have to choose. And my guess is that if inflation at least is down on a rate of change basis, which it should eventually. I mean, that's just the way the base effects work. So let's say we're at 4 or 5%, a year from now, and the employment picture starts to crack. I think at that point the Fed will maybe reluctantly choose to pay more attention to the employment mandate than the inflation mandate. And then you get into all kinds of other questions about, well, what does that do to real rates? Will the Fed have to start thinking about the Bank of Japan's playbook and start doing yield curve control if the bond market has really continued to unravel? I don't think those are questions for today, but those are things we should be thinking about, because if that latter were to happen, let's say the 10-year, which today is at 3.29, let's say it goes to 4, and it really starts to damage things in the economy, including the government's ability to fund itself, which it has, but it might take up a larger chunk of the budget in Washington. Will the Fed at that point go back to the 1940s playbook and say, we're going to cap long bond yields at 3 or whatever it is, and then you would lock in negative rates like we did in the 1940s, and then you start thinking about gold and Bitcoin and stores of value, commodities. And it's interesting, not to go off on a tangent too much, but gold. If you use the traditional TIPS model to price gold, which has worked for years and years and years, gold should be at $1,400 an ounce today. It's at $1,829 today. So something is happening in the gold market, and maybe it's just geopolitics with Russia, but maybe it's gold investors saying, at some point, the Fed's going to have to do some sort of yield curve control and repress long rates below the inflation rate, because that's how you get out of debt after all. And at that point, hard assets, stores of value, will command a premium.